Hello friends, let's understand the capital adequacy and the capital adequacy ratio in the banks. Broadly, any business and also the banking business is funded by two main sources of funds, which are equity or shareholders funds, and the next is the outsiders or the borrowings. The banks are fundamentally the most risk-prone organizations because the whole business of lending is prone to a very large level of risk, such as the credit risk. Now, in order to manage those risks, the banks require very large amount of capital. Hence, it is important that the banks have enough amount of capital. Therefore, this requirement has been recognized by the regulators since very long time. Approximately 3 decades back, the Basel standards came into existence. The Basel standards have been prescribed by Bank for International Settlements, and RBI as a member of Basel has adopted those standards. The Basel standards emphasized that the banks must have adequate capital adequacy. What does it mean? That each bank must have adequate capital in order to grow its business and also absorb the losses, if any. The standards evolved because of certain banking failures, and therefore they took into account what is the minimum amount of capital that the banks must maintain. This capital was calculated as a percentage of the risk-weighted assets of the banks. Now, the Basel II standard specified that the banks must have minimum 8% capital as compared to its risk-weighted assets. Basel III bifurcated this into Tier 1 capital and Tier 2 capital and prescribed that the banks must have totally at least 9% capital as a percentage of its risk-weighted assets, and of which not more than 2% must be the Tier 2 capital, which means the bank should have minimum 9% capital. The Tier 2 capital can be maximum 2%, which means it must have minimum 7% as Tier 1 capital. So that is where the capital adequacy of the bank requirement stands today. The bigger banks, the important or the systemically important banks, are required to hold a higher amount of capital, because if these banks go bust, then there will be entire system-wide impact, as we have seen in the case of global financial crisis of 2008, where big banks or investment banks like Lehman Brothers went bankrupt, and that had an impact on the entire US financial system as well as the global financial system. So capital adequacy standards are most important for the banks, and the requirements have been specified by the regulators which the banks have to follow.